Well, here's a lecture about Chapter 8 that I promised to give you, and I'm starting on page 265 of your book. And I know I've covered a little bit of this in class already, but I just wanted to make sure that you're aware of some of these concepts. And just keep in mind that Chapter 8 deals with stocks. And so what we're looking at is basically some of the basics of stocks, the fact that we buy a stock of a corporation so that we then have an ownership interest in the stock. And a part of having that ownership interest includes the rights to do certain things, typically vote for members of the board of directors, for example. And so looking at page 266, you'll see that if we are a shareholder, we get certain rights, voting rights. A corporation, before it can incorporate, has to file with the state. They have to file a certificate of incorporation, obtain a charter. They have to have bylaws, some things like that in terms of being formally, legally created and to be a corporation. Page 267 discusses the topic of directors and the board of directors and what their role is. And they have a very important role in a corporation. They're basically holding the top management of the company accountable to meeting the needs of the stockholders of the company. So corporations, you can see here, a lot of this information was on 266 and 267, formed by a state. Basically, um, you had a certificate of corporation that comes from a state. Typically, you file with the Secretary of State of a particular state that you want to incorporate in. You receive a charter that gives you um, the rights to operate, and then the bylaws basically will um, signify what your relationship is between the company and the shareholders. So rights of shareholders, of course, includes voting authority to vote for the members of the board of director, cumulative voting rights, and preemptive voting rights, or preemptive rights. And a preemptive right is the right to own a proportional share of stock, and that's on page 269. So if a company issues new stock, they have to go to their existing shareholders and offer to purchase shares from existing shareholders, um, or I'm sorry, sell shares to existing shareholders in order to make sure that they have the same proportion of investment that they had before. Of course, buying a stock means we'd like to receive a dividend. Cash dividends are distributed from earnings. Typically, they're paid quarterly. Some companies will pay an extra dividend if it's had a very good year. Irregular dividends are typically paid more like by a REIT because a REIT would be having irregular income flows, and so they have to pay 75% of their um, they have to give 75% of their um, dividends or income to shareholders to basically maintain their tax status. The payout ratio, basically, it's just what percent of earnings are paid out as dividends, and basically that kind of helps people or investors know kind of what to expect in terms of the earnings versus dividends relationship that the company has, and also what they call the uh, retention ratio. Also, is basically what percent of earnings are kept by the business and not distributed as earnings, and that information is on the bottom of page 270. That's the retention ratio right there. Of course, dividends typically will lead, higher earnings leads to higher dividends, which hopefully will increase share price. And lower earnings may not result in lower dividends. Some companies are very afraid to cut back on dividends because of the effect on stock price, investor relations, and some things like that. So usually, if a company has a bad year, they still would like to try to pay some dividends. They'll just have to take that out of an existing retained earnings balance that already exists. You can still have a net loss for the year and still pay dividends. Okay, and on the very bottom of page 272 is some key dates. Just be aware of what these mean. The date of record, basically the day in which investors must own shares to receive the dividend. An ex-dividend date is a date that if it trades that day, you're not going to receive a dividend payment. Um, and then what the date of record is, the distribution date, and so on. Just on the very bottom of page 272, be aware of some of that terminology. Dividend reinvestment plans are on the top of page 274. And basically, it's investing directly with the company. Any dividends that you earn go into purchasing additional shares of stock. A very automatic, it's a very easy way to save. It's a very passive investment in that we can put money into one of these, and basically dividends just keep buying more shares for us. Kind of one of those mindless passive investments. If we're very passionate about owning the stock of a particular company, it's a very inexpensive way to purchase that stock. The transaction costs are very low. Some companies will pay a stock dividend. They do that because they don't have a lot of cash on hand, but they still want to reward shareholders for certain items. Does not affect proportionate of ownership. It does not affect a company's assets or liabilities or equity, but it's basically dividending additional shares of stock to existing shareholders. It dilutes existing shares, and of course the price then becomes adjusted for the stock dividend. Stock splits do not affect proportional ownership either. Just like a stock dividend does not affect assets, liabilities, or equity. It does affect the stock's price, though. For example, if there's a 2-for-1 stock split and the price per share was $80, basically we have to dilute the number of shares available, and that price per share would go down to half. And so it's a good way for a company to reduce stock price. Sometimes companies want stock price to go down so the stock is more affordable and more tradable, which ultimately results in it going up. But sometimes companies don't want their stock price to be super high, so they will do a stock split to bring the price down. Companies can repurchase their own stock. In accounting, we call that treasury shares. In the book, they talk about stock repurchase and liquidations on 278, 279. It's the company buying its own shares of stock back off of the market. And there's a number of reasons to do that. The fewer shares outstanding means I have an increased earnings per share. It also means that the price of the stock will typically go up.